Hey everyone, it's Chris Hobart, the Wealthologist. Now today, I want to break down why the Fed's next interest rate decision, well, it might kind of seem like a small shift, but could actually be a huge deal for your wallet. So stay tuned. All right, let's talk a little bit about some money moves. Now, you remember back in 2020, the world basically shut down and the government started cranking out cash, kind of like Oprah giving away cars. Now, this was different than the economic situation in 2008. If you remember, the banks were locked up really tight, no money flow. Money during COVID, it flowed fast and furious straight into the economy. Well, what's the result? M2 money supply, which is basically the amount of money floating around in the economy, it shot up like a rocket, increased by 40%, which is absolutely amazing. Now, what happens when you flood the system with cash and people don't really have anywhere to go and spend that money except for Amazon? Well, inflation. Now, here's the thing. We were actually among the very first to call it. When everyone else was saying, it's transitory or it's going to pass, we're over here waving a red flag saying, no, this is going to be around for years. And guess what? We were right. Now, let's fast forward to today because inflation has cooled a bit. Consumer prices even fell in March, which is the biggest monthly drop since the early pandemic. Now, annual inflation, right now it's sitting at about 2.4%. And the Fed's favorite measure, PCE, it's right around 2.2%. I got to tell you, that's very close to their target of 2%. So the question is, should the Fed ease up and should they start cutting interest rates again? But this is tricky, right? Because monetary policy, it's kind of like steering a cruise ship, not a speedboat. It takes time when you make these changes. So if the Fed waits until inflation hits exactly 2% before tapping the brakes on their tight policy, well, by the time their action takes effect, we're already past the dock and probably headed towards recession waters. So here's the twist. That same money supply, M2, that signaled high inflation a few years back, well, it's now only growing at 3.9% a year. For comparison, it grew at 6% annually in the decade before COVID. And the thing is, we had low inflation then. In other words, I think there might be room for us to loosen up a bit. So what about the elephant in the room, the new tariffs? Because we're hearing plenty of folks freak out saying, that's going to spike inflation again. Now, I'm not going to say no, but I'm also going to say let's look at it a little bit differently because a lot of this is still kind of working itself out. You see, tariffs raise prices on certain items, but if people spend more on those goods, they have less to spend elsewhere. So total demand usually balances out. It's kind of like, I guess, squeezing a balloon. It might bulge in one spot, but it shrinks in another. Now, where tariffs can really hit and hurt, well, that's growth. You see, if businesses and consumers are left with less money, well, chances are they might pull back, stop hiring, stop investing, stop spending. That's why, if we're going to do tariffs, they need to be stable and they need to be predictable. They can't be bouncing around like a caffeinated toddler, right? So what does all this mean for the Fed? Well, we think there's a solid case for a rate cut, maybe not in May, but possibly in June. And not necessarily a full pivot either, but instead what we'd consider just a little loosening, something that gives the economy just a nudge without lighting the inflation bonfire back up. Now, while we're not backing off our view that inflation is going to average more than 2.5% in the coming decade, well, short term, well, the risk is actually on the downside. So here are the things that we're going to be watching and keeping you updated with. First, will the Fed stay cautious or are they going to blink first? Will bank regulations loosen up a bit to help the bond market? And also, what is the real impact of these tariffs? And what will that look like long-term and short-term for us? All right. I'd like for you to visit hobartwealth.com if you want to stay ahead of the curve. And if you haven't already, hit that subscribe button and give us a like so you don't miss future updates. Before I go, I do want to hear from you. Do you think that the Fed should cut rates in May, or should they be a little bit more wait and see? I want you to drop your thoughts in the comments below because we read every single one of them. All right, folks, I appreciate you watching. I'm Chris Hobart, the Wealthologist, and I'll see you next time on the Wealthologist Weekly.